On behalf of our team at HBKS Wealth Advisors, I would like to welcome you to What's Coming, Economic Outlook for Q2 and Beyond with HBKS Principal and Chief Investment Officer Brian Sommers. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. Today's presentation materials are available for download in the handout section of the GoToWebinar control bar. Copy of the presentation materials and a recording of today's webinar will also be emailed to you tomorrow. We'll be answering the pre-submitted questions throughout the session and at the conclusion of the webinar. If you would like to submit a question, please use the question box in the GoToWebinar control bar. If we do not have time to answer your questions, someone will follow up with you. We value your feedback. Please complete the survey at the end of the session to let us know how we did. If you would like a complimentary financial review, please contact us at 1-866-536-5776 or via the survey after the session. Today's session is hosted by Brian Sommers. Brian is a Principal and Chief Investment Officer for HBKS Wealth Advisors. He oversees the firm's investment processes and chairs the firm's investment policy committee. He is instrumental in the identification, evaluation, and recommendation of the investments that make up the firm's clients' portfolios. Brian joined HBKS in 2014. Good morning, Brian.
Good morning, Lori, and good morning, everyone.
We'll get started, and with one of the first questions that we got, the world endured many surprises in the first quarter. How did everything that happened impact your outlook for the year?
Well, for the most part, the surprises caused the outlook for global growth this year to be a lot weaker than we had previously thought. But by the end of the year, I think that the economy and the stock markets will be back on track. But at the top of the list of surprises that shocked the world was obviously Russia's invasion of Ukraine. The latest numbers that I've been able to find, that according to Reuters, is that the war destroyed about 30% of Ukraine's infrastructure at a cost of about $100 billion. The damage is essentially going to stop all exports coming out of Ukraine. At the same time, many companies have stopped doing business in Russia, and many countries have banned exports from Russia. However, these direct effects of the war on the global economy are actually pretty small. This chart, if you just go back one chart, the chart shows that the exports to Russia in the black portion of the bar, in Ukraine, the green portion of the bar, is a very small percentage of the exports of most countries of the developed world. And together, Russia and Ukraine only account for about 0.2% of the developed world's GDP and about 3.5% of global GDP. And then on the next chart, most companies' exports to Russia as a percentage of their total sales is also very small. There are a few exceptions, which we've shown here. McDonald's, IKEA, PepsiCo, and so forth. They do have a fairly significant part of their sales coming from Russia, but they have pretty much stopped operations in Russia. But so far, what I've talked about is only the cost of the war directly on specific companies and countries. However, that's just the beginning of the cost to the global economy. The total cost of the Russian war on Ukraine to the global economy is actually much larger and has the potential to do a lot more damage than these numbers indicate. So on the next slide, The reason for that additional damage it's going to do to the global economy is because the impact that the war has on inflation. Russia is the world's second largest producer of oil. They account for just under 12% of annual global output of oil. You can see they're just below the US and above Saudi Arabia. It's also the world's top exporter of natural gas. In fact, about half of Europe's natural gas comes from Russia. And then Russia is also a significant producer of other commodities, such as nickel, copper, aluminum, steel, and the prices for these commodities have skyrocketed as well. And then on the next slide, Russia and Ukraine are also major producers of food and other agricultural products. Together, they're often referred to as the breadbasket of Europe because they supply much of that region's food supply. This chart shows that together they account for 25% of global wheat exports, with much of it going to countries in Europe, the Middle East, and North Africa. They're also significant producers of corn, potatoes, and they also produce about 2/3 of ammonium nitrate, which is the primary resource that makes fertilizers. So all of these foods and fertilizers have had a significant increase in price recently. So on the next slide, you can see that the war is a big reason that we've seen the spike in inflation, which reached a 40-year high of 8.5% for the 1 year ending in March. And that comes after it rose 7.9% in February. And so the war impacts both energy and food costs, as I just described, in a number of other ways. The supply of oil has been reduced because many of the big oil companies have pulled out of energy deals in Russia. Many countries, including the United States, have banned the import of Russian oil. Russia had represented about 8% of shipments of crude oil to the United States. So the stoppage of the oil imports from Russia has caused the cost of diesel fuel to skyrocket. And diesel fuel is primarily used in trucking and shipping. And so as a result, delivery costs are driving up the prices of many other goods because of the higher cost of getting them to their final destination. Also, the price of gas, natural gas, spiked higher by more than 6% when Russia demanded that most countries in Europe pay for their natural gas in rubles. And most countries refused to do this. And so Russia stopped sending natural gas to Poland and some other countries because they refused to pay in rubles.
So, Brian, what will the effect of Russia's war on Ukraine have on the global economy?
Well, so the effect of the war is shown in the next chart and it will be higher inflation and slower growth. And so the left side of this page shows that economists estimate that the war could shave about 1% off of the world's GDP this year and raise global inflation. On the right side, the blue bar on the far right shows that economists are expecting global inflation to rise by about 2.5%. And then you can see on both of these charts, Europe is taking the brunt of this hit because of how much of their food and gas comes from Russia and Ukraine. And so higher inflation hurts growth. So these two charts are interrelated because it reduces the demand for goods as they get more expensive. However, while global growth is going to be trimmed, it probably won't be enough to cause a recession, except probably in the euro area. But the economy was already slowing, as we can see on the next chart. In the first quarter, GDP surprisingly dropped 1.4%. But growth should rebound the next couple quarters because consumers still have plenty of cash built up from the pandemic, and the summer months are coming, which historically has been when people boost spending on going out and dining out more often and traveling more often. So while it's definitely going to be a hit to global growth, and it's going to slow global growth to a point where it'll be lower than it used to be anticipated in 2022, but it should still be around 2 to 2.5% growth by the end of the year, which is slow, but not a contraction in activity for the full year, even though we had that contraction in the first quarter of the year. And then if you go to the next chart, while the economy is facing these headwinds, the United States Federal Reserve is still making it clear that they're going to be as aggressive as necessary in their campaign to fight inflation. Yesterday, the Fed raised short-term rates by 50 basis points, which is the largest rate hike that we've had since May of 2000. They've already raised rates by 75 basis points, and they're expected to raise them a total of about 2% by the end of this year. They're also expected to reduce their balance sheet by buying bonds to remove liquidity from the financial system and slow the rise in inflation. Many central banks around the world have also begun to tighten monetary policy to slow the rate of inflation. You can see on this chart, it shows how interest rates have risen from 6 months ago, pretty much across the entire yield curve. The yellow line is where rates were 6 months ago. The green line is where rates were just 1 month ago. And then the blue line is where rates were on May 2nd. And you can see, as that curve gets shifted higher, it means that rates are rising across every part of the yield curve. And then, so these higher rates the intention is to slow inflation. However, they come with additional costs as well. Higher rates lowers the demand for goods, which can lead to fewer homes being purchased and lower spending by businesses and consumers. And so eventually these higher rates will slow economic growth, which means fewer jobs, lower investment, and lower household incomes.
So, Brian, with that being said, we had a good audience question that would fit in here. What's your over-under on a date for the start of the next recession?
Yeah, that's a great question. And the recession dashboard that we're showing now really sums up my thoughts on when the next recession will occur. This was actually produced by Federated Hermes here in Pittsburgh. And so on the left-hand side, it has a number of factors that in the past have indicated when a recession will occur. The health of the labor market, the inflation rate, and housing, and so forth. And then next to that is the measure that indicates when inflation will happen. And then on the far right, it shows historically, whenever that measure occurs, how far in the future that would indicate that a recession would occur. And so all of these measures indicate that a recession won't happen until at least into 2024, except for the inflation indicator. And so the recent rise in inflation indicates that a recession will occur by the end of 2023. So I would use that as my over-under. I would use the fourth quarter of 2023 as my over-under, and I would bet the over because a lot of these factors still are indicating that a recession won't occur into 2024. So I'll talk about some of the challenges the global economy will face, but then I'll also talk about why I don't think that a recession will happen until we get into 2024. So if you go to the next chart, there have been numerous blows to global economic growth that will impact the economy the rest of this year. And some of these forces were happening even before the war in Ukraine made them worse. Inflation was already moving higher, but then the war made it worse by disrupting supply chains and the flow of food and oil to the world, as we've discussed. The Federal Reserve was already intent on reining inflation by driving up interest rates to slow economic growth. And if that wasn't enough, toward the end of March, the world also was reminded that the pandemic is still not over when Shanghai in China was locked down because of a new COVID-19 outbreak. And this has the potential to slow consumer spending in China and also potentially cause the disruption in supply chains to continue. The Chinese consumer is a crucial source of growth for many companies and countries, but their savings were already dwindling and wage growth was falling in China, so this could really slow consumer spending in China. So together, these shocks to global economic growth have increased the odds of a recession sooner rather than later. But I still think a recession will be avoided in 2024. One of the biggest concerns we start talking about on the next chart is a period where there is simultaneously high inflation and slow or negative economic growth. And that's called stagflation. And if we do get an extended period of stagflation, a recession does usually follow that period. In fact, there was a study done that we're showing here of mutual fund managers that was done by Bank of America that shows that the yellow line shows people who are, or the mutual fund managers that are anticipating a boom scenario or above trend growth and above trend inflation. The blue line shows people who are expecting stagflation or below trend and above trend, below trend growth and above trend inflation. You can see just a few months ago, over 60% of the people were expecting a boom scenario, while only 30% were anticipating stagflation. But now here we are a couple months later, and that situation has reversed, where there's been a spike higher in people anticipating stagflation and a spike lower in people anticipating a boom. So now 62% of people are anticipating a stagflationary environment. Now there are two periods in the 1970s that people usually think of when they think of stagflation. And the 1974 to 75 period, and then the end of the 70s into 1978 through about 1982. Both periods eventually led to higher unemployment and a recession. But this time we think that recession is likely to be avoided, or at worst, we could have a very short and mild recession before growth resumes again. And we believe this because there are several important differences between the economic environment today and the economic environment during the 70s and 80s. So on the next chart, like today, the inflationary pressures in the 1970s were worsened by an oil supply shock. However, today the world is much less vulnerable to a disruption in the supply of crude oil. According to this study done by Deutsche Bank, the amount of petroleum products used to produce economic growth in the U.S. has been declining sharply over the last 50 years. You can see that we are now below 40% of what it took, of the oil that it took to produce GDP growth versus the early 70s. Also, in the 1970s, the U.S. was a net importer of oil, where today the U.S. is now a net exporter of oil. So as a result, the recent spike in the price of crude oil will have less of a negative effect on GDP growth than it did in the 1970s. And it's likely that the spike in the price of oil that we're experiencing here in the U.S. will not be as severe and not last as long as it did 50 years ago as well. And on the next page, also during prior periods of stagflation, the inflationary pressures were happening at the same time that the labor market was very, very weak. You can see on this chart, back in the 1970s, in the mid-70s, the average unemployment rate was almost 8% during that time period, where today the employment level is extremely healthy, with the unemployment rate at 3.6%. So with a healthy labor market, the Federal Reserve has the ability to raise rates with less concern about causing a recession. So if you go to the next page, we believe that stagflation and a recession is not as much of a concern, or will not be as much of a concern once we get into the latter part of the year. With the rise in interest rates and higher inflation likely to cause some pullback in spending, combined with slower growth from China, the Federal Reserve may not need to raise rates as aggressively as feared to achieve the economic soft landing. A soft landing is what the Federal Reserve is shooting for as they raise rates. And what a soft landing is defined as when the Federal Reserve raises rates just enough to slow growth and curb inflation, but not cause a recession, which we think with the current economic environment, there's a high probability that the Fed can do that. As a matter of fact, that's what the Fed Chief Chairman Powell said yesterday, that he felt that there was a high probability that they would have the ability to do that. But still, even that being said, there is the risk that the Fed will go too far in raising rates, which could trigger a recession. But people and businesses that have accumulated so much cash that we believe even if that occurs, it'll be a very short and a mild recession.
So Brian, we got another audience question. Where are we heading investment-wise this year, and where do you see opportunities?
So it's a great question. Let's look at the stock market first. Looking back in the first quarter, stocks fell around the world. The MSCI All Country World Index, which is an index of the global stock market, finished the quarter down 5.36%. This chart shows the change in the multiple of the S&P 500, a domestic stock index, over the last 20 years. And you can see that after spiking higher, the valuation has dropped. And so what this chart shows is that line in the middle is the long-term historical average for the PE level or price to earnings level of the S&P 500. And then the dotted line above and below is one standard deviation above and one standard deviation below. Stocks are considered overvalued when they are higher, when the PE multiple is higher than one standard deviation above, and they're considered undervalued when the PE level is one standard deviation below. And so you can see that for several years, the stock market was what we would be considered overvalued, and because it was above one standard deviation. However, recently, that PE level has come down from 23 times future expected earnings down to 19 times expected earnings. And so now it is not what we would consider overvalued anymore. It's in a reasonably valued range, in our opinion. However, it's not by any stretch of the imagination undervalued. However, the price to earnings ratio that I'm talking about is based on the earnings that analysts are currently expecting for the rest of this year. And those earnings may not be realistic, because if we look on the chart on the next page, so that shows the change in analyst earnings expectations for companies in the S&P 500 on a quarterly basis. So this shows the 4 quarters this year. And we're right in the middle of the earnings season where companies are reporting earnings for the first quarter. And analysts have lowered their expectations for earnings for the first quarter. However, they have not lowered their earnings expectations for the rest of the year. In fact, they've actually gone up. If you look at the second quarter, the third quarter, and fourth quarter on this chart, earnings expectations for companies have actually increased. And however, with all the economic headwinds that we've discussed, and with economists lowering growth expectations around the world, it seems likely that it's only a matter of time before these earnings expectations are revised lower for the remaining 3 quarters as well. And when this happens, when analysts begin to lower corporate earnings for the remaining 3 quarters, it's likely that there will be some additional selling pressure on stock prices.
So, Brian, we all know that HBKS's investment strategy focuses on the long term and not reacting to market fluctuations. But what would you say to people that are near or in retirement?
So, yeah, that's a really good question, and I'll answer the question with the next several charts. So, first, I'd like to talk about stock market sentiment. And I get why people were very concerned about what to do, because people are very pessimistic right now. This is a survey done by the American Association of Individual Investors. And it shows that the green portion of the bar over the last several weeks, and then it also compares that to what the historical view is. And the share of people with a bullish outlook is near the lowest it's been since September of 1992. And it's well below its historical average. You can see it's around 16.4% versus the historical average of about 38%. Meanwhile, the number of people with a bearish outlook, or the red part of the bar, is well above its historical average and far exceeds those with a bullish outlook. Most recently, people with a bearish sentiment was almost at 60%, which is double what the historical average is for bearish sentiment. Now, from a contrarian perspective, this weak investor sentiment that is this weak, could be considered good news, because once sentiment bottoms out, stock prices tend to do better and move higher shortly after investor sentiment bottoms out. But the question is, when does that bottom come? And I don't think we're there yet. The issues that we've been talking about are likely to persist for a while longer. Also, the start of a Fed tightening cycle has historically been associated with a period of turbulence in equity markets. So a sustained rebound in stocks is likely to be delayed until later this year. In our opinion, stock markets could be due for further declines over the summer months as investors come to grips with these issues. But stocks should move higher again towards the end of the year when many of these issues are either resolved or close to being resolved. So on the next page, you can see that this outlook is consistent with the historical pattern of stock price movements during a period of Fed tightening. This chart shows, if you look on the bottom of the bar chart, where it says 0 months in the middle of that horizontal line, that is historically when the Federal Reserve begins raising rates. And then to the left of that, those bars represent the months before the Fed begins raising rates. And then to the right of that, the bars represent the months after the Fed begins raising rates. And so you can see here that investors typically take about 6 months to adjust to a Fed rate hiking campaign, where they typically struggle, stocks typically struggle a couple of months prior to when the Fed begins hiking, and then a couple of months after the Fed begins hiking. And so with the Fed really just beginning hiking rates recently, we have seen the downturn the few months before, so we expect it to continue for the next several months after as well. But then once we get into the fall of this year, there will be some additional positive developments that will be happening. Both the valuations and the growth expectations of many stocks should be more reasonable. You know, as I said, valuations in stocks are already down in the reasonable area, and once analysts lower their expectations for earnings, then growth expectations will be lower as well. That will be happening at the same time that corporate profits are likely to get a boost from rising government spending on defense capabilities and building out our energy independence. Also, there are some corners of the market are very inexpensive, and their earnings are actually improving, such as energy, utilities, and material stocks. So an environment of slowing economic growth, along with interest rates and inflation leveling off at modestly higher levels than where they are today, could provide an environment for modest gains in stock prices towards the end of the year, although the volatility that we're seeing is likely to continue. Of course, if the Fed does hike rates as much as it currently anticipates, then a much higher interest rate environment could cause a recession later this year or early next year. Now, I don't think that will happen, because as growth slows and inflation moderates, because of all of the headwinds that I've talked about, there's going to be less political pressure on the Federal Reserve to continue hiking rates. And so I think the Fed will back off and not raise rates as aggressively as many people believe they will right now, which could enable them to avoid a recession, and the recession won't happen until late in 2023 or into 2024. So to answer the question as to what an investor should do who's about to retire, my advice would be to maintain your long-term strategic allocation. These issues will eventually be resolved, and stocks will begin to move higher. Now, that being said, it would make sense to review your financial plan with your advisor. And if you do have the need for cash over the next year or two, it might make sense to put whatever amount you need into safer investments, like a short-term bond portfolio. But while the stock market is going to continue to be volatile, we believe that it's never a good idea to try to time market movements. And so for someone who is just getting ready to retire, don't panic, because there's ample time to recover short-term losses if you just stick to your plan.
That's great advice, Brian. So what is your perspective on investments in commodities at this time?
Commodities, as well as other real assets, such as real estate and energy MLPs, have done well the past few years, and I think they'll continue to do so, with a possible exception. The recent bout of inflation is actually good for most real assets. Longer term, inflation is likely to inch higher as the global recovery slows, which is still a fairly good environment for real assets. So crude oil supply continues to be tight. Valuations in many real assets are still fairly low, and private funds are buying real estate, especially industrial and commercial real estate. Other commodities such as copper, there's going to continue to be demand for them because of battery production related to green energy. So I continue to think that real assets will do well over the next several years, with the possible exception of residential real estate, which is likely to be hurt by higher interest rates. If you go to the next page, the fixed income markets. I'd like to talk a little bit about the fixed income markets now. So the bond market also, I think, will do better than many people expect if the scenario plays out as I've outlined. As with equity investors, many bond investors have been extremely negative on the outlook for bonds. And so it appears that fixed income investors are already pricing in the most aggressive Fed rate hiking scenario. Remember, I showed you how the yield curve has gone higher. They've already priced in the most aggressive Fed rate hiking scenario. But one important thing to point, I don't know, Lori, if you can go back to that chart just for a minute. If you could find that chart that showed the yield curve. Almost there. There you go, that one. So, one interesting thing that I think has happened, though, is while short-term rates have gone up a lot more than longer-term rates. So you can see how steep that blue bar is, where the short-term rates have gone up dramatically. But once you get to, say, 6 years out, from 6 years out to 30 years, that yield curve is fairly flat, which indicates that the yield between the 6-year bond and the 30-year bond is really not much at all. So to me, what that indicates is that the Fed is already pricing in the most aggressive Fed rate hiking scenario, but they're also recognizing that that's likely to slow growth, and longer-term rates are likely to come down. So to me, the fixed income market is pricing in the scenario that we discussed with lower long-term interest rates. And so if the Fed does hike rates less than investors think they will, those shorter-term rates could drop a bit. And again, environment of slower growth and interest rates and inflation leveling off at modestly higher levels, it's actually conducive to decent performance in the bond market as well. So the bond market may perform better than anticipated, and the next few months could be an opportunity to buy some fixed income. Now, I'm not saying that returns the rest of this year are going to be as stellar as they had been for a number of years, but it also won't be a repeat of the losses that we've seen recently in the fixed income market. So, I know there's a lot of people who have been a little bit alarmed at the losses they've seen in their bond portfolios this year so far. My advice there would be to stay the course, that I don't think that's going to continue. Those returns should stabilize. And then once the yields are slightly higher in the fixed income markets, then that will bring people back to bonds, and those returns will stabilize and then drift higher.
All right, Brian, thank you again. We have some time for a few audience questions. So the first one is, should dividends be part of our strategy during this inflationary period?
Yes, absolutely. But I've come from it, I think, a little bit differently than the way the person who was asking the question was coming at the question. I do think that a company that pays dividends can be attractive, but not just because they pay a high dividend. A company that pays a high dividend isn't worth buying if the price of that stock doesn't do well. So we look at the total return potential when we evaluate an opportunity, and the total return is the price change of that stock plus its dividend. And we focus on different aspects of that in different economic environments. And so I do think in this economic environment, focusing on the dividend aspect of that total return makes a lot of sense. In the environment that we expect going forward with slower growth, we think that companies that have a history of raising their dividend is more important than a company that has a high dividend whenever we're identifying an opportunity. Companies that have a history of raising dividends tend to have lower debt and are generating solid and consistent cash flows. And those are the companies that we think are going to do well, especially if the stock prices are reasonably valued. So those are the stocks that we are focusing on, stocks that are high quality, solid balance sheets, generating cash flows, raising their dividends, and have a reasonable valuation. And we're seeing a lot of those in the energy and in the utilities industry.
Okay, another audience question. Why doesn't HBKS short the market short term when there are indications it'll be negative?
Yeah, that is a question that we do get a lot. And in our opinion, I guess I shouldn't just say our opinion, all of the studies that we have done and all of the studies that we have read show that it is never a good idea to try to time the market by either getting into the market and getting out of the market, or, as this question suggests, shorting the market when there are indications that it'll be negative, and then reversing that whenever it gets positive. And the reason for that, there are a couple reasons, I believe. First of all, it's really difficult for anybody to tell with any certainty that stocks are going to fall. Even whenever things have been the most negative, a lot of times that's whenever stocks turn around. So even in the short term, when things are very negative and stocks do turn around, when stocks begin to rise, it can happen very quickly. And so an investor really has to make two decisions with almost perfect timing, and it's almost impossible to do. You have to make the decision as to when to get out of the market or when to short the market, and then you have to decide when to get back into the market. And from experience and from all the studies that we have seen, most of the people, even if you get the first part of that equation correct, and you get out of the market and you avoid some downturns, what inevitably happens is that by the time you feel comfortable getting back into the market, you've missed the majority of the rebound because things move so quickly. And you end up actually hurting your long-term returns instead of helping. And so because it is nearly impossible to make both of those decisions, all of the data shows that it is best not to try to time the market, not to try to exit or short the market in the short term, but maintain a long-term strategic allocation that you and your advisor have established, and stick with it. One of the things that we do with our long-term strategic allocation is that we include alternative investments that may hold up better in periods of market stress, which will prevent you from feeling the need to get out of the market. And so sticking to that long-term strategic allocation is the smartest thing to do in our opinion. Now, that's not to say that we, the investment team, will be making subtle shifts within your long-term strategic allocation to take advantage of some of the market anomalies that might present themselves, but it's all within the framework of your long-term strategic allocation.
That's great, Brian. It's so hard to focus when you're seeing the news and everything just looks crazy. So another audience question: will the inflation rate impact our expected rate of return over the next few years?
Yes, it will, and it really depends on how high inflation rises as to how much of an impact it will have. Some inflation is good for the economy. Some inflation allows the economy to grow. So if inflation were to settle back into more of a historically normal type of range, in that, say 4 to 6% range, then I would argue that would actually be good for the market, that stocks should do fairly well on a total return basis and a real return basis. Remember, to look at what you're actually getting, you have to look at stock returns on a real basis, which is essentially your return minus whatever inflation rate you're getting. And so if inflation stays in that moderate or normal range, I think stocks will do well. However, if inflation stays elevated, which again, we don't believe it will, then that will not only reduce returns both in the stock and bond market in the short term, it'll reduce both your total return but also your real return in the short run. And then longer term, it'll also hurt stock prices because it will likely slow economic growth, and so stock prices will continue to struggle. However, the bond market will, the higher yields that would result in the bond market could potentially, at least partially, make up for some of the declines in the stock market. So, again, for a person who maintains their long-term strategic allocation, there are typically things that move differently during different market scenarios. And so, if inflation stays elevated, that would hurt stock market returns in the longer term, but it would help bond market returns because of the higher yields longer term, which would offset each other. So in the end, it would probably, if inflation remains elevated at current levels, lower your overall expected return, not by a lot, but then again, we don't believe that that's going to happen.
Okay, Brian, we got time for one more question. With countries around the world with monstrous debt in an increasing rate environment, how do you foresee that impact?
Yeah, that's been a topic of a lot of discussion, and I think I come at it a little bit different way as well than many people do. So some people believe that all of the government debt that has built up over the last several years is going to lead to higher, potentially runaway inflation. And I think that's true in the short run, that it will it is a part of the reason why we've experienced higher inflation recently, along with some of the other factors that we've discussed. However, longer term, I believe that all of the debt that governments have added will slow growth because that debt needs to be paid off. And so money that would go to more productive projects won't happen because that money will have to go to pay the debt service on all of the debt instead of going to more productive projects. If you look as an example for what I'm talking about, you look at Japan. What has happened in Japan over the last really 40 years, they have been running a huge amount of debt. Their debt to GDP ratio has been, one of the largest in the world, and it has not sparked inflation in Japan. But it has contributed to their anemic growth. What we've seen is that they've had very low inflation and very low and weak growth. It's possible that the longer term impact of what we're seeing because of all of the debt is not runaway inflation, but a large portion of the world could become more like Japan over the next 30 years. That the world might be faced with very slow growth, low inflation when inflation will settle back into that 2 to 3% range that it was in before the pandemic, and modest stock market returns. I know that a lot of people say that a lot of the money floating around the system will cause a lot of inflation, but what I've seen is that what is most important is how that money gets multiplied through the economy. And, for the most part, banks really haven't been lending to the point where that money is going to get really accelerated through the economy. And with consumer spending falling off, consumers shifting their spending from buying durable goods to traveling more and going out to eat more, that has less of an impact on inflation. So there's a lot of things that I think are going to cause the inflation to settle back down into that low range, and potentially create an environment, like I said, with very low growth and low inflation for the foreseeable future.
Great. Thank you, Brian. Now, would you mind summarizing everything that we talked about today?
Yeah, sure. So I know we've covered a lot of ground, so I'll just kind of go back through and summarize our overall economic and market outlook for really the rest of this year and as we go into 2024. In the near term, we expect inflationary pressures to continue to intensify. The U.S. Federal Reserve will continue to tighten monetary policy, but eventually the higher interest rates, the war in Ukraine, the Federal Reserve tightening conditions by buying back bonds and raising rates, and the slower growth coming out of China due to both the lockdown in Shanghai as well as slowdown in consumer spending because of wages dropping in China, all will cause growth to slow, which will prompt the Fed to hike rates less than anticipated and avoid a recession until 2024. And if we're wrong on that fact, and if the Fed does continue to hike rates, that would likely cause a recession earlier, but it would likely be a mild recession and a shallow recession before growth then begins to resume shortly after. an environment of modest growth and modest inflation may boost the prices of both stocks and bonds once we get into the second half of this year. And areas of the stock market that we think will do well, although we do think that stocks are going to remain volatile this year, but there are some pockets that we think are going to do well. The oil and gas and metal industries are likely to do well. Companies in all industries really, with solid balance sheets and are generating cash. Companies that have strong competitive positions in every industry and have pricing power are likely to do well in a slower growth scenario. And then regionally, there are some commodity exporting countries in Latin America and Africa and the Middle East that are actually benefiting from the rise in oil prices. And so, as we get into the latter part of the year, I think it could be the type of environment where some of those emerging markets might finally, I know people have been calling for the emerging markets to do well for a long time, but I think with valuations extremely inexpensive there and some of those countries benefiting from the rise in the price of oil, we could finally see returns from the emerging market countries begin to do well once we get into the latter part of the year. And that about sums it up.
Thank you, Brian, so much for your insights on the market and your economic outlook. I would like to encourage anyone attending today's session to visit our website for an overview of HBKS services and insights from a wide range of financial topics from HBKS thought leaders like Brian and others. And please don't forget to complete your survey after the session ends to provide us feedback for future webinars. Also, we have uploaded Brian's latest market commentary and the presentation slides from this afternoon in the handout section. If you have additional questions, you can submit them via the survey through our website at hbkswealth.com or by calling us at 866-536-5776. And again, as a reminder, we are offering a complimentary financial review for anyone attending the session. Thank you again to Brian for his insights, and thank you for attending today's session. We look forward to hearing from you.
Thanks, everyone.